Hi everyone, my name is Tifany Alfiana Anisa Putri. I'm a student at University of Indonesia, majoring in tax administration. I'm glad to be here with you today. In this presentation, I will talk about personal income tax in Indonesia for entire workers explained. Now let's get started. Personal income tax in Indonesia is determined through a self-assessment system, meaning the residential taxpayer need to file individual income tax return. Residential taxpayers are subject to progressive tax rates ranging from 5% to 30%. Given the consequences of non-compliance, foreign workers should seek help for registered local tax advisor to better understand their tax liabilities. Expatriate workers need to know that personal income tax or PIT in Indonesia is determined through a self-assessment system. The country has adopted with a worldwide income taxation system, meaning that individuals considered as Indonesia tax residents pay tax to the government on the income they earn in Indonesia, and also on income they earn from abroad unless there is an applicable double tax agreement. Non-residential taxpayer will only be liable to pay PIT for the income they earn in Indonesia, unless the country in which they are a tax resident has an applicable tax treaty with Indonesia. In this case, the taxpayer might not pay any tax in Indonesia or pay a reduced amount. Given this tax treatment, it is important for expatriate workers to understand their tax liabilities in Indonesia. It is feasible to use the service of registered local tax advisor to help determine which tax law regime will be applicable along with any exemption that may bring. So, who is eligible to pay personal income tax in Indonesia? Foreign workers that are designated as tax resident in Indonesia must pay PIT. The key criteria to determine whether or not an individual must be considered as an Indonesian tax resident isn't nationally, but rather the length of stay or intended stay. A foreign individual is considered a tax resident of Indonesia when they meet the following condition. First, in country for more than 183 during a 12-month period in Indonesia, any who has spent the length of time in the country, regardless of the type of visa they are using to visit the country, will be considered as tax resident in Indonesia. Intends to resident in the country for more than 183 days, even if they have spent less than 183 days in the country. For instance, the case where the individual depends have moved to Indonesia and it was clear they are staying in country for a reasonable length of time. And individual who works abroad from more than 183 days within a 12-month period, but they are still earning any form of income in Indonesia, must pay PIT on the Indonesian income. Individual that works overseas for more than 183 days within a 12-month period and do not earn any income in Indonesia are not eligible to pay Indonesian PIT. Notably, the expatriate will be considered a tax resident in Indonesia until the date of their final departure from the country. So, individuals exempt from personal individual tax. Certain foreign expatriates, because of their special legal status, are not considered as Indonesian tax resident and are exempt from paying PIT. Even if they stay for more than 183 days per year or resident and intended to stay in Indonesia. This exemption applies for first, foreign diplomatic and consular personnel. Second, military personnel and civilian employees of foreign armed services. And the third, representative of international organizations specific by their Minister of Finance. Scope of taxable income in Indonesia. According to the Personal Income Tax Law, income must be defined as an increase in economic capital. It can consist of, among others, employment income and personal investment income. According to Article 4 of Chapter 3 of the law, income includes first, employment income. Second, income from the exercise of an independent profession of business. Third, passive incomes like dividends, royalties, interest, insurance gains. Next, capital gains from the sale or transfer of property and rents and other income from use of property. Next, tax rate. When it comes to tax rate, resident and non-resident are taxed differently. Residents are subject to a withholding progressive tax. Their net taxable income is set at graduated rates, which current rate ranging from 5% up to a maximum of 30%. Depending on an individual's income. And non-residential are subject to a final withholding flat tax of 20% on gross income. The progressive tax rate is currently structured around four income bands, with rates that apply to the fractional income within each band. This is the table, income per year and rate in percent. Up to 50 million rupiah, there is 5% rate. Between 15 to 2015 million rupiah is 50 rate percent. Between 250 million rupiah until 50 million rupiah is 25% rate, and 50 million rupiah and above with 30% rate. Deduction and reliefs. There are several elements that can be deducted from the gross income when determining the annual taxable income of an individual. It is worth noting that a family is regarded as a single tax reporting until with a single tax identity number or NPWP in the name of the head of the family. The head of the family needs to report the income of their dependent spouse and children their tax return. The following personal deductions are available for resident taxpayer. This is the basic of deduction and deductible amount per year. For individual taxpayer, there are 54 million rupiah. Spouse additional 4.0 million rupiah, and each dependent additional 4.5 million rupiah. Next, employer compliance obligation. Income tax in Indonesia is mostly paid by withholding by their employer. The tax withheld by employers must be remitted to the government body on a monthly basis. Employee compliance obligation. Expatriate employees are required to complete an annual tax return and compute their taxable liability by March 31 of the following tax year. The majority of PIT is paid through stationary employee withholdings on earned income. However, for any other income that a taxpayer in Indonesia earns on a regular basis, they must make monthly professional tax payment to the tax department based on the income earned in the previous year. Filing a tax return. In order to file a tax return, an individual must register as a taxpayer in order to obtain a tax identification number or NPWP. Expatriate must abstain on NPWP if they are a tax resident, while employers are responsible for deducting tax of their employer's salary, but it is the individual employee responsibility to register as a taxpayer and file the tax return. The last is when leaving Indonesia. It is highly recommended that expatriate leaving Indonesia permanently cancel their tax registration to avoid any misunderstanding, and thus avoid being continuously considered a tax resident of Indonesia. To do so, expatriates should submit an application to the local tax office, which will then perform a tax audit on the taxpayer returns and supporting document prior to granting approval to the register. The individual should ensure that all tax-related documents are readily available in anticipation of a tax audit, including bank statements, salary bill, foreign tax documentation if applicable, works contracts, and so on. So, thank you for watching this presentation, and bye bye.